Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." This statement encapsulates the essence of Buffett's market psychology, a guiding principle that has helped him amass his wealth and navigate the unpredictable waves of the stock market. Buffett's approach to market fluctuations is as unique as the man himself. While many investors might panic at the sight of a falling market, Buffett remains calm and composed. He understands that the market is like a pendulum, constantly swinging between optimism and pessimism, and it's this understanding that allows him to make rational decisions when others might be succumbing to fear or greed. This isn't to say that Buffett is immune to the emotional turmoil that often accompanies market dips and peaks. However, he has a knack for separating his emotions from his investment decisions, a skill that's not easily mastered but is essential for any investor hoping to follow in his footsteps. One of Buffett's key insights into market psychology is recognizing the role of fear and greed in driving market trends. He knows that when investors are fearful, they tend to sell off their stocks, causing prices to fall. Conversely, when investors are greedy, they buy more, pushing prices up. By understanding these dynamics, Buffett is able to take advantage of opportunities that others miss. For instance, during market downturns, instead of succumbing to fear and selling off stocks like many investors, Buffett sees these moments as opportunities to buy high-quality stocks at discounted prices. He understands that market downturns are temporary and that in the long run, the value of a good company will always rise. So, in essence, Buffett's market psychology is about staying rational, understanding the emotional drivers of market trends, and seizing opportunities when they present themselves. It's a mindset that requires patience, discipline, and a deep understanding of market dynamics. So, how have you experienced market fluctuations? Have you ever found yourself succumbing to fear or greed? Or have you, like Buffett, been able to remain calm and rational, seizing opportunities where others see only risk? We'd love to hear about your experiences and insights. Share your thoughts in the comments below. Buffett follows a value investing approach, seeking out undervalued companies and investing in their potential. Now, you might be wondering, what exactly does value investing mean? At its core, value investing is like unearthing hidden gems in a market full of stones. It's about discovering stocks that are priced less than their intrinsic value, the real worth of the company. These are the stocks that the market might have overlooked, but hold immense potential for growth. And this, my friends, is the cornerstone of Buffett's investing strategy. Buffett doesn't just buy a stock because it's cheap. He delves deep into the company's fundamentals, scrutinizing its financial health, management quality, competitive advantages, and potential to grow over the long term. He believes in understanding the business behind the stock, its products, its market position, its future prospects. This allows him to assess whether the stock is undervalued and worth investing in. He once famously said, "Price is what you pay, value is what you get." This highlights his focus on value over price. He doesn't shy away from buying expensive stocks, as long as he believes the company's value justifies the price. However, it's important to note that value investing isn't about making quick bucks. It requires patience and a long-term perspective. Sometimes it might take years for the market to recognize the true value of these undervalued stocks and for their price to appreciate. But when it does, the returns can be spectacular. So, how can you apply this approach? Start by learning to analyze a company's fundamentals and its growth potential. Look for stocks that are trading below their intrinsic value, and most importantly, be patient. Remember, as Buffett says, the stock market is a device for transferring money from the impatient to the patient. What's your best investment find so far? We're curious to know. Drop your answers in the comments section. Buffett is a staunch believer in long-term investing. He once stated, "If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. The essence of this statement lies in the power of patience and the virtue of foresight. So let's dive into this concept. In the world of investing, it's easy to get swept up in the hustle and bustle of daily stock movements. Yet the real magic unfolds over a longer timeline. Long-term investing is about seeing beyond the immediate fluctuations and identifying the potential for growth over years, even decades. It's about understanding that the true value of an investment may not be apparent in the short term, and that's perfectly okay. Think about it like planting a seed. You don't expect to see a tree the next day, right? You water it, you nurture it, and over time it grows. That's the same principle that applies to long-term investing. Now, let's talk about how this strategy played out for Buffett. He didn't become one of the wealthiest people on the planet overnight. He invested in companies like Coca-Cola and American Express, not for their immediate returns, but for their enduring value. These investments, held over decades, have contributed significantly to his success. Long-term investing also offers other benefits, such as the power of compounding. This is where your investments generate earnings, which are then reinvested to generate their own earnings. Over time, this snowball effect can lead to substantial growth. But remember, long-term investing requires patience, discipline, and the ability to stay the course even in the face of market volatility. It's not about timing the market, but time in the market. So as you embark on your investing journey, consider the wisdom of Warren Buffett. Look beyond the immediate and focus on the potential for long-term growth. After all, Rome wasn't built in a day, and neither is a successful investment portfolio. If you want to learn more about long-term investment strategies, don't forget to hit the subscribe button. Risk management is a crucial part of Buffett's investment strategy. Just as a captain navigates a ship through stormy seas, an investor must steer their portfolio through market volatility. The legendary Warren Buffett is a master mariner in this regard, guiding his investments with a keen understanding of risk and reward. One of the cornerstones of Buffett's risk management strategy is diversification. Rather than putting all his eggs in one basket, Buffett spreads his investments across various sectors and industries. This way, if one area suffers, the impact on his overall portfolio is minimized. It's like a safety net for your investments, catching any that might fall. But diversification is not just about spreading risk, it's about understanding where to spread it. Buffett is famous for his mantra, invest in what you know. He encourages investors to understand the businesses they're investing in. It's about delving deep into a company's fundamentals, understanding its business model, its competitive landscape, and its growth prospects. Buffett also keeps a close eye on the company's financial health. He scrutinizes balance sheets, income statements, and cash flow statements to assess a company's financial stability. He looks for companies with strong cash flows and low levels of debt, which are more likely to weather economic downturns. Another vital aspect of Buffett's risk management approach is his focus on the long term. He doesn't let short-term market fluctuations sway his investment decisions. Instead, he keeps his eyes on the horizon, confident in the long-term prospects of his investments. And finally, Buffett is not afraid to sit on the sidelines if he cannot find attractive investment opportunities. He understands that sometimes the best investment is the one you don't make. This patience and restraint are hallmarks of his disciplined approach to risk management. Risk management may not be the most glamorous aspect of investing, but it's a vital component of a successful investment strategy. And as we've seen, Buffett's approach to risk management is as astute and insightful as his investment picks. For more on risk management techniques, check out our playlist and don't forget to like this video. For Buffett, investing isn't just about making money, it's also about giving back. Now let's delve into what that actually means. Warren Buffett, arguably one of the most successful investors of all time, has always been a proponent of ethical investing. This means he believes in putting money into companies that are not only financially sound, but also uphold strong moral and ethical standards. He's known for avoiding investments in companies that he believes harm society or the environment. This is a core part of his investment philosophy, and it's something that sets him apart from many other investors. But Buffett's commitment to doing good doesn't stop at his investment choices. He's also one of the world's most generous philanthropists. Buffett has pledged to give away the majority of his wealth, and he's been doing just that. Through the Bill and Melinda Gates Foundation, he's donated billions of dollars to causes such as education, healthcare, and poverty alleviation. Buffett's philanthropy is rooted in his belief that those who have been fortunate enough to amass wealth have a responsibility to give back. He once famously said, "If you're in the luckiest 1% of humanity, you owe it to the rest of humanity to think about the other 99%. So, what can we learn from Buffett's approach to philanthropy and ethics in investing? Well, it reminds us that investing isn't just about making money, it's also about making a difference. It's about using our wealth to create positive change in the world. It's about being responsible, not just to ourselves, but also to our society and our planet. Buffett's philosophy challenges us to think beyond profits and consider the broader impact of our investment decisions. It encourages us to invest not just for financial gain, but also for the betterment of society. If you believe in responsible investing, give this video a thumbs up and share it with your friends. And remember, keep investing smartly. Thank you for joining us on this journey through Warren Buffett's investment playbook. For more insights into the world of finance, don't forget to subscribe to Simple Saving Squad. Until next time, keep investing smartly.